The broadcast is now starting. All attendees are in listen-only mode.
Good turnaround Tuesday, everybody. Let's have a good day. So yesterday I started off talking about the 78.6 level here in the Dixie. That could be ripe for a bounce. We've gotten it. So I'd say that this is pretty critical for the bear case and the dollar to continue. Should start failing from here. So turnaround Tuesday candidate could be the euro. Not crazy about that. It took out the 1720 breakout, but 1680 pretty good support. So we'll see if we could get a reversal back to the upside in euro. Well, this high was confirmed on the 4-hour. And pretty much so, not much divergence, pretty good reading on the 1. So we'll see if we could get another blast and achieve the targets up here. We had something like equality from here. We could get up to this 1860 level, take out the bears, and then maybe we'll take another look at it. So that's what I see there. U.S. oil has really become kind of dormant here. Could be a failing rally. Maybe this was A and this is ABC for B. I don't know. I'm Dale Pinker. Sometimes I think I'm Gregor Horvat, but he's much better. So your first sign that a top is really going to manifest would be action back under 73. Hi, David. How are you today? And U.S. dollar yen finally have taken out a lot of the bears. I think they're all gone now. Well, at least a lot of them, took out this high and this high. So actually, it was smart not to go with last week's little reversal candle. That was kind of just like a trap. I think we should at least take this high out. That's 111.39. And I remember some longer term targets took us up towards 12.20. And with risk on, that's possible. Kind of confirming the action up here if this candle closes good on the 4-hour. Getting a little divergence on the 1. So even if it's going to be some type of peak, there still should be another push up after some kind of pullback. So the yen probably getting closer. Don't think it's going to come off dramatically until we get some type of peak here. And I'm going to be keying shorts or whatever I do with my bearish ETFs off of the strength, which is, I'm going to have to ask Steve if he uses IWM for the Russell 2000. But we're almost at new highs here. It's not going to confirm this time. I believe Steve's levels were about 71.80, 171.80, 172. So it could take till, near the end of the week for that to happen. It doesn't have the same oomph that we had yesterday. So looking for 172. Now this will be a new all-time high. Okay. So would the NASDAQ if we get that new all-time high there. It'll be a new all-time high. But I know it feels like a new all-time high in the S&P, but it's not the all-time high. All we're doing is challenging and taking out the high before this pullback. And maybe they want stops above this level right here over 2,800. And look, there's a 1.272 at 28.17. So even though NASDAQ and Russell much closer, been leading the whole way up with a strong dollar. So if we're going to get a turn in the dollar, that could have some impact on the Russell. And I just wanted to show you, even though it feels like we're making new highs in the S&Ps, we're still 100 handles away, 90 handles away from this high up here. So I would say that most of the bears that thought we had it here, I was one of them, fortunately covered half of my position in ETFs down here. I was just looking for a retrace to 61.8, but turned out to be much more. But it doesn't mean that I'm not still stalking some short signals going into the second half of the month. So those are some of the things that I see. We'll see if we get this reversal in the euro. Still has a lot of work to do if it's going to do it, but the beginnings of a reversal candle are there on a 1 hour, and actually on the 4 hour actually getting one. Should have at least 17.5 in it if it pops from here. Oh, thank you, Zia. So any questions on anything I've covered or something you want me to take a look at before I hand it off to Blake? Warriors? Cable? Yeah, Cable had that negative day yesterday. Really fought its way back. Well, if you're bearish a dollar, I look at this high here on the 1 hour, and it looks like it's a confirmed high. I know that we had 33.5 identified as resistance. Lydia even brought it up during the interview last week that we needed to get through 33.5 before we had a shot for 36. And I would say if we get this from here, we're going to at least recover. So I have a hard time wanting to be short Cable after this action that it held pretty well. And maybe we would get another shot back over 3 that could take us back to major resistance at 360. I hope that helps. I'm going to save the rest of the board for Steve. And I'll just give you my one look at silver because I think there's a chance that, that would, a lot of people were calling this head and shoulders right here, right? Well, it's no head and shoulders, even if it's good and we have another rally left in it. The head and shoulders is gone. Everything's going to hang on the dollar, buddy. The euro doesn't recover and starts closing under 1680. There could be a good shot for another new low coming here in silver. Hope that helps. I'm going to save Euro Aussie and those crosses for Blake and Steve. Good morning, Blake. How you holding up in the monsoons?
Oh, it's nasty, Dale. It's just nasty.
I got thunder here this morning.
Huh?
Thunder here this morning.
Oh yeah, we got all the storms, and it's it was raining like cats and dogs yesterday, which I mean, we went from like 100 and I don't know, it's like 110 and humid. It's like Florida. Yeah. It felt like worse than Florida. It's like you felt like you're in the armpit of whatever, and then the front came through and it was probably like 75, 80 degrees. And now it's just back to hot and humid. It's, 90 and humid. It's gross. I mean, this is the grossest time of the year. I mean, there's no if and or buts about it. This is the time of the year where you go, why am I even here? Why, what am I doing?
I asked myself both in Chicago and Arizona several times, why did people settle here?
Yeah, but then you get spoiled.
Air conditioning. They didn't even have air conditioning.
Yeah,
in the older days.
And then you're here that the other 7-8 months out of the year. That's just it's gorgeous. Beautiful. I mean, we have a convertible as one of our vehicles, and the top is down the whole winter. I mean, and you can't say that about most places. I mean, you really can't. You have to deal with a few months of gross weather, but the rest of the year is great. There's not a lot of bugs. It's it's crisp and clean and nice. It's just it's these couple months that are really gross. But
I used to just jump on the 17 or Beeline Highway and head up north to escape it. You're an hour and a half from beautiful mountains too.
Yeah, we have a family cabin that we go to, which is nice. And
where's it at?
It's in Prescott. So,
oh, nice. Yeah.
and I mean, the temperature is usually about 20 to 25 degrees cooler, especially being in the woods. It's not in the valley,
Yeah.
so it's actually in the woods. So it is definitely cooler. But anyway, enough about the weather.
Okay.
let's talk about the market. So as far as the cable goes, I got a question about the pound. Stelios wrote a really good blog post yesterday. If you guys didn't get an opportunity to read it, make sure you read it. It was tweeted out yesterday, not only by myself. I think you tweeted it. I think the ForexAnalytix account tweeted it. So make sure you have a read. I haven't bought the cable. I was long a couple of times. We had a pattern in play. I closed it out because I was a little unsure about the price action yesterday when we sliced through this 132.50 level yesterday. But the cable, is actually holding up relatively well. I was thinking about buying it this morning, and I did not yet. But for all intents and purposes, we're holding some pretty decent support zones. I can actually just bring this down a little bit, and you can see just through, all these, spike lows, high, low, all these highs through here. This is a big support zone, and we're actually finding support through here. So, while we're trading above 132, I think the risk is for a higher pound. And like I said, I haven't bought it. I don't own it, but I still take a look at the longer term, view of the cable. And when I say longer term, you can just scroll out to like this 4 hour. I have to take a step back when I see all these intraday gyrations. I have to, take into consideration. We did have a, let's go ahead and put this blue. We had a descending wedge. We broke out of the descending wedge. We completed a double top, right? And so it's still constructive, even though I'm not long. I feel like I should be long, but I'm not at the moment. So if you're bearish, I'd be very careful. Like I said, I'm not long. I feel like I should be long. I haven't found a good placement for myself to be on the long side. I think if I would have been a little bit more diligent about trying to pick it up near the 132 level yesterday, I still feel that if we see some dollar strength come through the market, that might be the place to buy it. But I don't have that. I don't feel like there's that opportunity that's jumping out at me just yet. So, if we can get a dip back to 132, I might pick it up. But, sorry, I didn't mean to yawn on you. I really apologize. But looking at the euro dollar, so the euro dollar, broke stalled at the 78% retracement. We actually broke the 117.20 level, broke some a little minor support, but we're already getting a lift, and that's following the weak German ZEW numbers that came out overnight. But the euro, frankly, still looks fairly constructive as well. I would be a little nervous about being short the euro dollar at this point. I think the euro dollar, like I said, I think it still looks a little stronger. I personally will do better if the euro weakens and the dollar strengthens. And the reason why I say that is because I am long the dollar Canadian. If you watch the week ahead video, I was looking for a move to 130.50. I started buying it yesterday at 130.75, picked up more at 65, and I'm not long a full position because I wanted to be long more if we hit 130.50. But if you use ForexAnalytix, then you know that I put in a pattern in play yesterday as well, because I'm playing against this longer term trend line, big breakout point on a weekly basis, the pullback to this breakout point here, longer term trend line. And so I established a long position, and I plan on holding it through the Bank of Canada if we are somewhere around here. going into tomorrow. So I think we can, rally all the way back up to 132. I think we can pull back below 131, but I'd prefer to see us around these levels tomorrow if I'm going to stay on the long side of the US dollar Canadian. I haven't made that decision yet, because that's not until tomorrow. But I do feel that, people have been buying the Canadian dollar ahead of the Bank of Canada, and so now you're starting to see that maybe shoring up of some position squaring ahead of the Bank of Canada. So that like I said, I've picked up the dollar Canadian. I like it on the long side, and I still think it plays up towards 133 to 134 tomorrow if the Bank of Canada is a little bit more neutral. Now, one of the things that does make me a little nervous about the Canadian currency, if you look at the COT data from Friday, short positions continued to mount up until last Tuesday in the dollar Canadian. Now, one of the things that some of those positions might have been squared up towards the end of the week because you saw the breakdown below the 131.20 level last week. So that might have stopped out a few of the traders who were positioning themselves short early on, which was reported in the COT data. You might have gotten some of those out, shaken out a little bit over the last couple of days. But overall, I still like to be on the long side of the dollar Canadian, knowing that, longer term, this dollar Canadian looks like we're going up towards 140. So, and this is obviously worrisome if you're short the dollar, because if the dollar Canadian is true, like let's say I'm right here in the dollar Canadian and we are going higher, where does that put the euro dollar? Where does that put the cable? And so, like I said, I'm thinking about buying the pound. I haven't bought it, and maybe the better position here is being long the pound Canadian, which you can see the 200-day moving average here is really well supporting the pound Canadian. So I think a move back above 180 I think is doable, but there would have to be something NAFTA related, trade related, that would actually put the dollar Canadian up at those levels, or the pound Canadian up at those levels, I would think. But that might be a decent play. I'm not long the pound Canadian. That's just something that I'm, it's kind of on my radar, if you will. The Aussie dollar, we had this double top started playing out yesterday, and you can see the double top actually should extend to 74.25, but we're already starting to see some firmness, if you will, of the Aussie dollar. As we are coming in a North American session. The Kiwi as well. The Kiwi is pulled back towards the neckline. Actually, I could probably be a little bit better about drawing this neckline here, and the Kiwi should find some support around here. Maybe this was it. Maybe that was the low. I don't want to totally talk about things other than the dollar currencies, but I do have to mention gold. If you guys are trading gold, I just went long, by the way, and let me read you the analysis from yesterday. Basic technical analysis in gold. Okay. And this is from yesterday. Gold could push back towards the 1250 level as stops above the last week's resistance was hit, then reversed. However, the 1250 level may offer a good risk reward for longs. It says Fort longs, but that's my bad typing, because I wrote that yesterday evening. Then today we dropped below the 1250 level, and we were taking out some stops. And I said gold has taken out stops below 1250 level, which may be a setup for longs intraday soon. And I bought some gold when we were trading below 1250, and as you can see, we're trading at 1251 right now. So we broke below this low, took out a bunch of stops, and now we're starting to reverse. Now, the reason why I want to be long gold is because and I'll go talk about the yen here in a second, but we're at this big multi-year trend line, and yeah, I mean, it does come all the way down to, 1243, 1242, somewhere around there, maybe 1245, somewhere down here. And I still feel that gold is, as long as we trade above this 1240 level or 1238 level, you want to be long down here. The risk reward is still skewed to the long side. Now, when I talk about risk reward, it doesn't mean I'm going to be right. I always try to point that out to people, is that I'm not always right. And if anybody, says that they are always right or close to always right, they're absolutely wrong. This is it's not realistic. Okay. But if I'm buying down here and my risk is here, okay, so let's call that risk being 1. And where's my reward? Well, maybe back up to 1300. Well, if I risk 1, I'm looking to make probably about 4, right? That's a good risk reward, any which way you slice it. I would take that trade every day of the week, all the time, not even thinking about the other, the macro point of view or the fundamental point of view of whatever I'm trading. If I have a risk reward of 1 to 4, I'm going to take it, and that's it. But now talking about gold, just in general, what's the other mounting evidence why we could, bounce at these levels? Well, if you look at the dollar yen is trading at a multi-year trend line here, right? Here, I got a little bit of a mess going on here, so let me get rid of that. Okay, the dollar yen. Now, depending on how you draw this trend line, you can draw it right up against the spike highs, okay, which will take us to about right here, which comes in around 1150 or so. Or I had it drawn a little bit earlier, maybe draw through the wicks, which would take us about where we're at right now, maybe slightly lower, but somewhere around this 11150 or spike high from back here in May. It's all right around here. Okay. So if the dollar yen does stop at this multi-year trend line and it starts to reverse, yen and gold have a very correlated relationship. So if gold indeed does bounce from 1250, which, obviously we went as low as 1247.70 or something, whatever we did in gold, and we're already back above 151. If gold starts to rally, that may play into yen strength, which would be dollar yen weakness, which it's right up against resistance. So not only do I have like all these technical levels lining up in gold, but I've got correlated assets with very similar setups, so that those correlations may play very well into the trades that I'm taking. So again, this isn't just necessarily a gold play, although I do think that gold is a decent long down here. That's why I'm long. But also the dollar yen may be a great short, as gold is near a lot of support, if you want to think of it in that way too. All right, which I am short the dollar yen, by the way. All right, so these are just a few things that I'm thinking of and I'm trading today. Now, a couple other things that we should probably talk about. Let's go over to the US dollar Norwegian krona. That's finding support right at this head and shoulder neckline. But if the dollar really starts to break lower, if we break through this 797 level in the US dollar Norwegian krona, that could be quite bearish event for the US dollar Norwegian krona, and like I was just explaining to you guys on the dollar yen, it may be firmer, but let me put something else up here really quick. Do I have it on this chart?
Blake, can I just add one thing before you?
No, you can't.
Okay, all right, bye.
All right, hey Stelios, yeah, what's up?
Hey, I just wanted to add that we had, in case people missed it, we had the Norway Cpi today, came in at 2.6% year on year, expected 2.4%, way still above target. So I was actually expecting dollar Norway to finally break below 8. It didn't. I'm still short, but very frustrated with it. But I'm keeping it.
I think that probably has more to do with dollar cross movements at the moment, right? I mean, the dollar's just bid against a lot of different currencies, so that's probably the reason why, I would assume.
Yeah, very likely.
Yeah, it'll take out that base, Stel. I'm rooting for you.
Thanks,
Stelios. We are.
It's taking its time, that's for sure.
You need the patience of Job for this formation here.
Yeah,
you know what Job was?
I don't.
Oh yeah, he was a guy that everything terrible happened to him, and he had patience and didn't lose his faith. Old Testament story. He was tested. Yeah,
okay.
Job. Yeah. Unlike Lazarus, which is what I think I am.
So I got to tell you guys a funny story. So I went to get, I got married in Greece. Now I don't come from a religious family. I'm sorry, the dollar Canadian's trying to break higher at new highs here, which I'm happy about. I didn't grow up in a religious family. So when I was going to get married in Greece, I had to be baptized Greek Orthodox in order to get married in Greece. So I went to the Greek Orthodox church in Dallas, and the priest was like, he's like, I actually ended up going church for a couple of years. And by the way, it was a great community. I loved going to that church. We went for years following while we were in Dallas. With my God family. Anyway, so I'm meeting with the priest for the very first time, and he's like, "Okay, so you want to get married in Greece? You got to be baptized, but we want to make sure that you go to church quite a bit, and you attend service and be part of our community, and everything else." And we were talking, and he goes, "Oh, what month were you born?" I was like, "Well, I was born in August, whatever." He goes, "Oh, me too." I said, "Oh, you're a Leo." He goes, "No, we don't believe in that here." I'm like, "Oh,
no."
Yeah. That just shows you the
I have a better one. When I was a bachelor
of myself. What? Huh?
When I was a bachelor, I have a better one. I was sitting there eating, and some woman approached me, and she said, "What's your sign?" And I said, "Stop." Stop sign.
How'd that work for you? I bet you she picked up her and laughed.
Well, yeah. Of course, that was the whole purpose. You see, you got it. Yeah. All right.
Oh, that's funny. God, I never turned down a woman at a bar. Anyway. All right. So enough about that. Steve should be here. Thank God. Get me out of here. Thank God for the World Cup today, huh?
So yeah.
Which match do we have today, Steve?
We have France with Belgium. Actually, the best of the two semifinals, in my opinion.
Yeah. So my father-in-law, who's Greek and used to play for the Greek national football team, excuse me, years ago. He thinks Belgium's the dark horse. So
it might be the case. Both teams are very strong. What time? In 6.5 hours exactly from now.
11 o'clock our time, Dale.
Okay, thank you.
Yep.
Good.
So anyway, should be an exciting day for football, even though we call it soccer. But the FX market, I'm assuming, is going to die down here in a couple hours. But we are seeing some volatility.
Yeah, we are so far. I mean, we are getting some, an attempt from the dollar to react. I think that, this is actually happening at interesting levels. Euro USD is trying to post an evening star formation right on resistance. Cable hasn't managed to hold above 133. So I do think that, we need to see more evidence before we call this, before we call the continuation of the dollar weakness we had last week. Now, having to do with the game, as you said, I do believe that volatility is going to dry down the closer we get to the game. But until then, we might have some more action. What do you think about stocks, though, Blake?
They're strong. Look, we're past. Everybody's shorted ahead of the tariffs. It ended up, the market ended up shaking it off. So that's, I would assume, what caused the squeeze, last Friday going into, today. There's probably a lot of funds that are underperforming still that have to chase the market higher. So I don't see any reason why the stock market can't go higher. I don't know if it will go higher. I think that, this S&P false breakout that we're setting up today is a little scary, especially after such a big rally into resistance. I think that I wouldn't want to be long. I can see the reasons why the market's going higher. I wouldn't want to be long here. Let me just put it that way. And the Nasdaq, is not making a new high. The Nasdaq 100 here, the S&P, like I said, if we close lower today, this is going to set up as a false breakout above the recent highs, and the S&P is underperforming the rest of the the Nasdaq at this point. So I don't know. I think the market. I wouldn't want to be long, but I see the reasons why it's going higher. Like, I know why it went higher over the last couple of days.
By the way, I don't know if you've noticed, but actually cryptos are getting massacred today. Ethereum
no, I actually didn't even take a look at. I tend not to. I look at them like usually once a day, and aside from doing analysis, like usually, when I'm completely bored and I'm like, okay, what are cryptos doing? But no, they're getting worked. Yeah, Ethereum is really not looking good, because if Ethereum cracks this 400 level, it could be ugly.
Yeah, I think it's going to go to 250 below 400 actually.
Yeah, and you know what? If or when Ethereum makes it down to the $100-$200 level, I mean, I may be opening up a Coinbase account or something soon, and taking some money and putting it into cryptos to put it away, because you don't know.
I want to do that too.
Yeah, you don't know if there's so much money behind cryptocurrencies, whether you believe in it or not. I sure would hate to be the guy that missed the internet, because I participated in the internet growth back in the late 90s and early 2000s. That was
your breakout, wasn't it?
It's what made me. I would sure hate to miss another opportunity if it arises. I'm not saying that this is the end all be all, but maybe it is. I don't know. Maybe fiat currency ends up going away. But I'd like to see some lower levels first, and then I might put
buy an 80% discount. What's wrong with that?
Well, it could end up being 100% discount. So
exactly.
But at the same time, I don't know if I could really face my kids 20 years from now and they go, well, Dad, why didn't you, look at cryptocurrencies? This is how everybody's using money nowadays. How come you didn't? You're in the markets. How did you not see it? So again, I don't. They
cancel their subscription with you as father,
right? But I don't. I think these levels are doable down here. I don't think that this would be, a place where we can go. And like I said, for me, it's, I park a little bit of money that if I lose it, I lose it. If I don't, I don't. But it be more for my kids, not for myself, not as a trade,
more
as an investment.
In a wallet, Blake? Do you know how to do the mechanics of getting a wallet and?
Yeah, I got to go through the whole process. It's just such a pain.
I asked our guest yesterday if it was possible for yuppies like me if I could get a leather-bound wallet that I'd feel more comfortable with, because they're just
dude. Just put it on a hard drive and then stick it in your back pocket, and you'll
Hate to lose it.
And make sure you don't throw it in the garbage can, because you remember.
That's what I mean. Yeah.
You remember, Blake, the stories about people that were once involved with Bitcoin, like very, very, very initially, and then they completely abandoned the whole thing. And when it started picking up in price, they started like trying to dig in, garbage burial places, etc., because they had what was worth like millions of Bitcoin, and they were trying to find the thrown away hard disks.
Crazy. Yeah. All right, guys. Well, hey, I'm gonna pass it on to you all. Have a great one, and happy and go France. Sorry, I had to say it.
Je suis fromage.
All right. See you guys.
All right.
See you later, Blake.
You know what that means, Steve?
No, I speak English, German, and Greek. That's it.
Je suis fromage means I am cheese.
Okay.
So, Steve, I wanted to ask you, I was thinking about the Russell, and when you came up with that 170, 180, 172 level, was that off the IWM or off the Russell? Because there's some price differentials between the two.
IWM.
Okay. Thank you, buddy.
It is.
Got it.
It is.
Okay.
Yeah, we are trying to. Yeah, we're trying to make it.
Yeah, I'm going to key on that level for doing something in bearish ETFs.
Yeah,
when we get there.
Let's see, because
if we get there,
we might actually make it there. I mean, we're just a couple of 2-3 days of bullish price action away from that. But
right into the summit with Putin.
So having to do with risk, since you brought the conversation there, having to do with risk, Nasdaq is testing the previous highs, but that goes well with our plan. Our plan.
Well, that's right. You had it up there, 74.30.
See another bound, perhaps. Yeah. So we might be looking at let's put some more extensions. We might be looking at a larger ascending wedge here. So we might make it all the way up to 7,558 or at least 7,431, the 127.2 or the 141.4 extensions before we see another leg lower. Now, having to do with the S&P, since we broke above this trend line, I think that we need to respect the upside as long as this trend line is holding. As I had said, I was not being persuaded by all the bearish scenarios unless we cleared 2,690. 2,690 held like a champ.
Yeah, you were exactly spot on.
Yeah, so as long as that level is holding, and especially now that we've broken above it, as long as this descending trend line is holding, I really wouldn't be bearish one way or another, right? So we need to respect the trend. We need to respect the fact that perhaps this was the correction, and the correction is over since some time ago. So there is a chance that what we're seeing here is already like the second leg higher in the new push after seeing this corrective move. So there is a good chance that we're going to head all the way to new highs, and we need to respect that possibility, simply because this is a multi-year uptrend, and as simple as that.
How about cleaning out stops over 2,800, which is where we peaked at, that high that we had after the first break that we never got to before this decline. Clean out the bears over 2,800, whatever the number goes to, and then still have a C wave because it's still not
absolutely
higher high.
Absolutely can happen. And somebody can claim that this big corrective move lower in 2015 almost made the same thing. Like we had a sharp leg lower, right?
Yeah.
We then started recovering. The recovery then started getting more aggressive. I remember very well that a lot of people were persuaded up here that that was it. The correction was over and we were heading to new highs. And then we got another sharp leg lower, right? Yeah. And then when people started getting bearish down here, this is when the uptrend resumed. So can what you say happen? Yeah, absolutely it can. But on the other hand, we have to be fair. how many times during this multi-year uptrend have people said, okay, perhaps we're going to break the previous high and this is going to be a fake move, and then we're going to turn lower and everybody's going to be trapped being bullish and the index is going to collapse? How many
You
times?
were right. I did a couple times.
Yeah, and the vast majority of the people have done that a couple of dozen times.
A couple of
right?
million times.
Yeah. Exactly. So, bottom line being is that, statistically speaking, you always have to begin by acknowledging and respecting the trend, which, as far as we know, remains a bullish one. Now, as you said, we had the precedents. That's why I showed it to you, because I have that in mind of 2015, that people got trapped, that the correction was over, then we had another leg lower, then people started getting pessimistic, then we actually got the resumption of the uptrend. So can this happen again? Yes, it can. But that's why I'm still looking one level at a time. When we were moving lower, I said 2690. Unless this breaks, I'm not persuaded that I should be short. Now we broke above this level. As long as we remain above that level, I'm not going to be persuaded to be short once again. So that's what I think. Now, having to do with the DAX, for example, DAX tested today this area of resistance we were talking about, getting rejected so far. As long as 12,600 remains, resistance and holds. I think that there is still a chance that we might see another leg to the downside. Now, having to do with the FTSE, though, be careful, because the FTSE is likely breaking higher. We were talking about this textbook corrective channel yesterday, and I do think this constitutes like a bullish development. I do think that the FTSE presents a good opportunity of being long from a technical perspective. It would be my preferred index to be long at the moment. It's the one I have less hesitations for in comparison to others. Okay. Now, having to do with the Nikkei, I need to stress out here that the fact that we got no continuation after breaking below 22,000, definitely this double top target, which was at 21,000, did not get fulfilled. And we're seeing like a big reversal higher. This obviously skews somewhat the technical picture here. Still, I think that, in order for me to turn bullish, I would still need to see a break above 23,000. As long as that doesn't happen, I'm really not convinced, or I wouldn't want to be involved with that. One thing is for sure, and I wrote it in the weekend analysis as well, that having to do with the USD yen, things are quite simple here. We have a confluence of resistances at 111.50. Why? Because 111.50 has been several times support resistance in the past, and most importantly, from 111.50, we have this descending trend line that has been tested multiple times and has held so far. I do think that a break above this trend line, especially if confirmed on a daily and even better on a weekly closing basis, is going to be a major event and will probably open up a lot more upside for the USD yen. So I do think that we're getting close to the point of getting some kind of an event here. Either that's going to be like a big rejection from this confluence of resistances, or it's going to be a breakthrough this confluence of resistances. One way or another, we're going to know quite soon. I definitely don't want to be involved with the USD yen as long as it's so close at resistance. I'm not convinced that it's going to be moving lower, because I don't see the structure. From a risk reward perspective, obviously shorting here, because you know where you're going to be wrong, makes sense. So I would definitely not blame anybody for wanting to be short and taking like a chance and risking little to perhaps make more. Personally, I've stayed away from this pair because it's been trading very strangely. It's unfazed in the vast majority of the days. We've even seen it lately trade oppositely than risk on occasion, oppositely than the rest of the USD pairs do. So I do think that this FX pair is, somewhat or at a big extent manipulated. So I'd rather stay sidelined until at least I see it make some kind of a big move, or anyhow break some kind of a big level as this one is. So far I haven't been involved in a long time, and I don't intend to get involved unless, as I said, we get a big rejection or a big push through and follow through after that, in which case I will then have a stronger bias of what's about to happen there. Right now, having to do with what I said before, listen, I was mentioning yesterday, we were talking together, Dale, and I told you that, listen, let's wait to see how the day closes, because at that point when we had the webinar yesterday, both the Euro USD was trading above this descending trend line, and the cable at that point was trading above this horizontal resistance area at 133. Now, both of them actually managed to close the day lower, and they still remain lower. In fact, just a while ago, the Euro USD was at the lows of the day, threatening to post an evening star formation right on the triple confluence of resistances, because actually this is a triple confluence of resistances. Let me zoom in so you can see it. It's the 23.6 from the February high to the lows. It's the 50 DMA that's there, and it's also this descending trend line resistance. So I do think that there is a nice chance to have some follow through in the upside in the Euro USD, but if and only if we do finally clear this 117.50 area and actually manage to hold above it. So until that happens, I have to remain skeptical, and the same thing applies with the cable as long as it remains below 133. It has already broken above a descending trend line, descending wedge, which is definitely a first step. But I also want to see it clear this horizontal area of resistance. The same thing applies with the Aussie and the Kiwi. Why? Because I actually covered the Aussie twice yesterday because we had a question later on, and I said that, listen, a very nice rebound so far, but unless we clear the 75-cent area, which is like a double confluence of resistances, the 50 DMA is there, it's also horizontal support resistance area, I cannot get enthusiastic for the upside. So far this level is holding, and as long as it does, I cannot jump the gun. Same here with the Kiwi. Kiwi posted an inverted head and shoulders formation on the 4-hour chart. You can clearly see it here, but you can see it if we go to the 4-hour chart. Here it is. So an inverted head and shoulders formation, but I would still want to see a break above 0.6880 to begin with. We haven't seen that yet. Okay, so I think we need to be a little bit more patient and give it a few more days to see, in fact, what the dollar wants to do. As you see, the dollar is rebounding from here, from the 50 DMA. It didn't reach actually the 93.40 resistance. Now we need to see what kind of a rebound that's going to be. Obviously, so far we're attempting to form a morning star formation on the DXY. If the DXY closes near the highs today, that's going to be quite a bullish signal. Now, if by the end of the day it has more or less failed and closes, just being positive and not at the highs of the day or whatever, this might have been just a short-term rebound, and we might see one more leg to the downside. So I said yesterday as well that I believe that we're going to probably need a couple of 2-3 days to get more clarity having to do with what's happening with the dollar. And that's absolutely fine, because as long as you know what kind of levels you want to monitor and what kind of levels you want to see, to get bigger conviction, it's fine to wait for them. Now, let me, by the way, you already showed USD NOK, and I want to show USD SEK as well. First of all, I have to say that the fact, Blake said that USD NOK is rebounding from this neckline. Keep in mind, this is a triple confluence of supports, right? Why? It's not only the neckline of head and shoulders formation, it's a horizontal area of support. It's also the 200 daily moving average that's in there. Here it is, the blue one, right? So triple confluence of supports. As Taylor said, Norwegian CPI beat. Norwegian CPI is very high. Norwegian CPI is at 2.6%. And, under normal circumstances, having expected 2.4, which is anyhow above target, and seeing 2.6 should have led to a big appreciation of the Norwegian kroner. And regardless of if the dollar is bid or not bid against other pairs, USD NOK should have made a decent move to the downside, which it hasn't. And that actually worries me because, what happens when you see a market not reacting as it should be reacting to news? So what can you tell about a market that should react to, in this case, bearish news, because the news were like bullish the NOK, so bearish the USD NOK. So what happens to a market that it doesn't respond in a bearish manner to bearish news? Usually not a good sign, right? Regardless, 8 remains the line in the sand, and the daily close below it is going to be needed to trigger this formation. Until that happens, the only thing somebody can say is that the pair is currently on support. So, selling it right as it's bouncing off support after news that should have helped it actually penetrate through it doesn't seem like a good idea to me. So if you were short from higher, sure, perfect. But, shorting it here doesn't make much sense. Let's have a look at the USD SEK. USD SEK, as you see, is trying to post a Morningstar formation exactly at confluence of supports. So you have to keep that in mind. Obviously, same thing applies here. This is not the place to be shorting USD SEK because it's actually trying to rebound from support. Now, if it actually manages to break through that, I do think that we're headed to 850 next. And, then you can be thinking about shorting it and looking for the next downside target. Now, let me see what questions we have after Bitcoin. Treasuries. Yeah, absolutely. Let's have a look at treasuries. And actually, we haven't done that in some time. Let's have a look at both the bonds and the treasuries. So, bonds, big picture. Multi-year uptrend, consolidating in a triangle since 2 years ago, right? Descending triangle. And as you see, oscillating from resistance to support, and it has been doing that for 2 years. Bottom line, I think that the closer we get to this triangle's resistance, the worse idea it is to try to actually buy them. In essence, I also believe that they're losing momentum in the short term here, so it wouldn't surprise me if I saw another move lower, right? So I do think that getting involved with the bonds, selling up here for short-term move is a better idea, obviously, than buying. But I do think that getting involved right here, doesn't make much sense if you want to, hold in some way. Now, having to do with treasuries, if we look at the daily, there was an obvious potential for a flat top triangle, the same thing that others call an ascending triangle, which is like a bullish formation, because you expect that if this flat top is taken out, then the move higher should extend. And that's exactly what I initially expected when I was predicting that we would rebound again from this descending wedges resistance. We did get the rebound. We got then a formation that looked like it could break to the upside and give us one more leg higher. But what we're getting instead is this, which this is the 4-hour chart now. It's the same thing on a 4-hour chart, right? Which admittedly doesn't look that bullish because we broke higher from that potential flat top. We proved that the wedge interpretation was probably the correct one. And now we're dripping lower. So, if we see some kind of an acceleration, I do think that we're going to be headed to new lows. Regardless, I think that 119.26, which because if you want to make it in, if you want to, There it is. So it's 119.8 in essence. Is going to be support. As long as we stay above there, of course, there is another chance that we're going to push higher. But especially if we break below there, I do think that the treasuries are going to be posting new lows. So I think they're quite in danger. I'm closely monitoring, regardless. Did we get any news? No. Okay. So let me see what other questions we have. Dale, do we have an interview today, by the way? Nifty, you're asking about the Nifty. Let's have a look at it.
We have Peter Goodburn today, Steve, so this is going to be a good interview, I think.
Okay, nice. Okay, you're asking about the Nifty. I told you my opinion about the Nifty several times ago. This is a triangle. I think this is, this is a bullish breakout that's happening. And, you have to respect it. I think that the chances for a new high are high, right? I mean, we corrected lower, we moved higher, we consolidated in a triangle, we're pushing higher once again. I don't see anything bearish with the Nifty yet. So, I would be bullish after this breakout. You can never know 100% sure if it's a fake breakout or not, Niraj, but doesn't look like it. I mean, I think it has decent chances of producing follow-through. I think it has more chances of producing follow-through than anything else, if that's what you're asking me. Why? Because the whole structure and price action seems consistent, right? Push higher, triangle, another push higher. So, yeah, the chances of being a fake breakout are always there, but I don't think they're very high. I mean, there are less than 50% chances, if that's what you're asking me. Gold and silver, let's have a look at them. Obviously, we're getting a pullback in the vast majority of the metals, but look at the price action today. Silver at some point was testing levels lower than yesterday's lows, and it's getting bid once again, right? So as it seems, there is some kind of a bid for the metals. Same thing with gold. I do think that if we see a daily close above 1260, then gold is going to extend higher towards at least this descending channel's resistance. So bottom line, we already seen that happen, so we can take it away. Close above 1260. I think that we're headed at least towards, let's say, 1275, this descending channel's resistance. And if we do break afterwards that one, then we can be talking or looking for more bullish targets. Until 1260 breaks, you have to respect the downtrend and the potential that gold is going to resume to the downside. So let me be very clear. Only a daily close above 1260 starts opening up upside targets. Until that happens, you have to respect the downtrend as and the potential for more weakness as the higher probability direction, right? So that's it. It's as simple as that. Retracement demand is lower half. Yes, USD-TRY. Yeah, thank you for reminding me. Obviously, the USD Turkish lira is not very happy with Erdogan being re-elected and doing his stuff. And what do you see here? Yep, we had already drawn that since then. It's a triangle. And what do triangles do?
He made his son vice president.
Yeah. So what
like
do
Jared
triangles
Kushner.
do? Yeah. So what do triangles do, Dale?
Oh,
They usually break in the direction of the trend.
Yeah.
Yeah. So
it could be
what
a terminal
do we expect?
if that's a 4, but
it could be. It could be. But bottom line, if you're asking me what I think is going to happen, I think that the Turkish lira is going to test the 5 handle. Okay. By the way, I was looking at it some time ago. 10-year Turkish bonds yield how much, Dale? Give me an estimation.
8%.
Yeah, you're almost there. Almost 18%, 17.7%.
Oh, wow.
Is the yield on the 10-year Turkish bond. So good luck.
What's it backed by? Hash?
Steve, you buy 10-year Turkish bonds to get 18% yield, and you lose that in a month in the currency, right?
Yeah, that can. I mean, I honestly believe, Stelio, that 18% for the 10-year Turkish bonds is stupidly low, because not only you can suffer from further depreciation in what is one of the best established uptrends in the FX world at the moment. We're talking about a multi-year ruthless uptrend, but you invest in Turkish lira, which not only suffers from depreciation, but what is the inflation rate currently in Turkey, Stelio?
I don't know, but I'm guessing the high double digits.
Even if they don't report high double digits, do you have any hesitations that the unofficial one is going to be that high? I don't personally.
Well, it's not backed by gold, guys. It's backed by hashish.
15% is the answer.
People that would have an appeal to.
Yeah, 15%. So actually, you get a real yield of 2.7%, right, Stelio? You get a real yield.
All that risk associated,
and you carry all that risk associated, which makes it, as I said, a very, very low return, if you ask me.
Midnight Express, that's all I can say. I tried to watch it last week. I couldn't watch it. I turned it off. I had a panic attack. Anyway, Peter's here, guys.
Okay. Enjoy the interview. See you all tomorrow.
All right.
And enjoy the game tonight.
All right. Thank you, Steve. Thank you, Stel, Blake, Peter. I see you in here. So great to have you back, buddy. I'm going to make you the presenter. Look forward to our talks as I have through the years. Welcome back to Face, Pete.
Right. Dale, can you hear me?
Yeah, I can. I got you, buddy. How are you?
Pretty good, actually. Thanks. It's nice to talk to you again.
Yeah, how many years do you think it's been, Peter? 3, 4, at least?
Yeah, well, who's counting? But yeah, something like that. I mean, time does fly.
You do enough counting with your charts. I count this, right?
Yeah, absolutely. No, it's been a few years now, but it's been great because to be part of your organization has been really good to see what you're doing and updating so professionally. And I have to say, Dale, you're really up there, and I really appreciate you contacting me, because it's really great because we talk the same language, we see things in the same way. We also have a good history of the markets, which is fun to go back to in time and seeing what we discovered and what we've learned since. It's great experience. So thanks.
You're very welcome, Peter. And that was a great segue, because before we get to the charts here, I was interested in talking a little bit about what separates and distinguishes your work, which is synonymous, from the multitudes of Elliott Wave practitioners. There's many out there, and some are good and some aren't as good, and I can vouch for you being spot on so many times over the years. Is it the time that you put into your analysis, or is there any different twist that you use in your wave counts that most don't even know about or consider doing?
Well, I think there's a combination of things. First of all, it is certainly the amount of time you put in. I mean, I can see that, especially with some of my tutors, some of my pupils when I've taught Elliott Wave in the past. I mean, there's a clear distinction between those who want to put in the time and those that don't really. But I think also I have one tip for anybody that is doing Elliott Wave, and that is that go back to Elliott's original writings, especially in Nature's Law, which was published in 1946. You get a feeling that his work was incomplete, but he was getting into this point where he was looking at symmetry, dimension, geometrics. This is where Fibonacci overlays come in, of course. Everybody in the FX world knows about the use of Fibonacci stuff, but it goes a bit deeper. And if you start looking into what Elliott's initial works were about geometrical measurements and stuff like that, you then probably sort of start reading books about geometry, patterns in nature, all of these types of elements. And you begin to get a certain rhythm and idea of how markets are trying to evolve. One of the big setbacks for anybody trading Elliott or analyzing Elliott is the fact that also without this idea and concept of geometry, symmetry in the patterns, you're really left with distortion on several times. You can be influenced by the news flows, or you can be influenced by some other exogenous event or sentiment situation, and you will distort those patterns. But if you work from this geometric principle idea, which Elliott was touching on the sides of when he was in his last years of working with this and developing his theory and refining it, you'll get to a point where you look at the patterns not from distortions anymore, but looking from the symmetry point of view. And therefore, when you start measuring the patterns and their amplitudes, you will see that there's a high frequency recurrence event where, for example, a zigzag where waves A and C are geometrically measuring the same more often than not. Or there's a relationship between waves A and C through an extension type ratio approach, which I can show you, for example, on this dollar index.
Okay. Let's go the buck here.
Yeah, you can see my charts, right? And
yes, got them.
I mean, if we just tick a box 38.61.8, and if we go up here to measure a zigzag completion, here's 5 waves up into last month's high, and we just extend a couple of ratios, you're going to get 2 upside targets. Now, the 38% target for wave C of a zigzag is predicated on the depth of wave B. It has to be at least 50%. If it's 38% or shorter, then we would naturally go up to the 61.8 area here. And the main reason for that is because we're trying to geometrically ensure that we're not seeing a distortion in the measurement between waves A and C. This is very important. There are, of course, always exceptions to a rule, no matter what you look at. But generally, if you just keep to this concept of playing out the repetition of these patterns and these measurements, you will get great amount of hits. And when you do see a little bit of divergence or deviation, it really brings your focus and attention into it. And then you can start working with different degrees of trend at the same time, just to see how malleable that trend deviation is occurring. And invariably, you'll be able to pick up the slack later. So I come from a perspective on Elliott Wave where customer drives your product. And a lot of our clients, most of them are institutional clients, and they've, I have people in my books for the last 25 years, and they're still with me. But they're very, when you get to that point, you're driven by success and results. And if you make a mess of things and you don't get something right, you have to find the solution to why it went wrong. So there's a lot of introspection. There's a lot of feedback going back over a scenario. Why did you forecast it this way? Why did you forecast it that way? Would there be?
It might be a silly question, but do you actually journal those things?
Do I do those things?
The things you do. You journal. Kind of like write down when a scenario didn't work out and what you didn't see and that you look for next time, or you just remember it, you take a mental note?
No, I do both, actually.
Okay.
I do both.
All right.
Yeah, I actually make notes and say, well, why did that go wrong? What was different then? I found also,
I think that's a great point. And I want to just emphasize it, Peter. You've been trading, you've been in these markets and doing this for how many years?
Well, look, I daren't say 40 years, but it has been. I don't know.
And Peter still writes things down and journals and goes over his work, reassesses. And so if someone who's been in the market for decades does it, it's probably a good idea for people that have been doing this for a few months, a few years, to be in the habit of having that discipline so that you learn from your mistakes. And I just wanted to make that point that, a lot of us after many years, we just stop. And so that's also something that I think sets you apart is your intensity for, it's your bread and butter. You have to get things right.
Absolutely. And, there's motivation to do that. Obviously, if you're working alone, and I know, many people are sitting in their office or their desk and they're trading currencies or whatever, it's very hard to keep up that incentive. There've got to be some incentives to produce. And I would just say, look, it doesn't matter whether you're doing Elliott Wave or any other methodology, as long as it works and makes you money, that's good. But if invariably you have a bit of a clanger, which I mean, you have, one of those times when you're giving back all your hard-earned money because you're over-leveraged or you've got one particular, go back over that, have a good think, be retrospective, don't be afraid. I mean, it can be daunting to do that because you're facing a loss. Nobody likes to have a loss, and it feels bad. You feel sick. But these are things which to be really efficient and to getting those results consistently over time, you really have to be afraid of your darkest soul, and you have to go into that and start examining what you were thinking at the time. And sometimes you forget, if you're doing so many different things or you've been distracted, it's a good thing to note down why you went into a trade. In fact, I do that for my own trading. I always write down, why did I want to do it at that particular moment? Because invariably you sometimes go back and think, actually, I don't remember why now. I mean, you should know why every time, but sometimes your mind plays games and you don't want to face the truth. So you hide it from yourself. But if you write it down, well, you've got nowhere to go but to look at your own handwriting.
Great.
But anyway, it's an important aspect.
Yeah. Okay. So we're looking at the dollar here, Peter, and I think as long as I've been talking to you, you've had negative bias, and you're answering my question here. I was going to ask you what you thought of this rally from 88.5 to the recent high at 550. If it was just another bear market rally, or there's more to it. And I could see from your count here that you're looking, depending upon, as you explained earlier, if it's a shallower correction, we could look for higher levels, a deeper correction, not as high. Am I reading your work correctly?
Yeah, absolutely. I mean, again, it's good to go back over things and see what happened. I actually had a very good introspection with my own work, because this chart I'm just putting up now was dated February 2nd, so it was pretty much at the lows. But I still thought there'd be one more twist down to 87.72 before we got this. Yeah. I mean, I was looking at this. I thought, well, look, we're missing a little fourth, and we need a little bit of a dink down to 87.72. Yeah. This was a 61.8 proportional ratio of the measurement of 1 to 3. And I felt pretty comfortable with that. I actually even spread it out time-wise a little bit, because I don't know if I got this. I was showing a client this earlier. This is my own composite cycle, which I've developed on a daily basis, that is. And for those of you who aren't familiar with cycle work, the idea on a composite cycle, at least, especially when you overlay it like this, is not to project where the amplitudes. This has got nothing to do with amplitude of price. I mean, if we're working with amplitude of price, we work with Elliott Wave for pattern, and price terms amplitudes, we're working with fib price ratios, extensions, and so forth.
This is more like seasonal tendencies, or just the cycle of highs and lows, how they run.
Yes, I mean, this is not seasonal. This is basically a composite of about 5 or 6 different cycle intervals, which I've done manually. I've gone back and looked over and seen what regularities are involved, if there's any misdemeanors, but we've put them together in this software and then it produces a composite. But it's basically timing. You can see the timings here. The low here was pretty good. Here was a bit late. The cycle was late. And it was late here, actually. But it did complete the thrust that we saw in May. And that's interesting because you'll often find here, look, here's the absolute high for the dollar index in January last year. But the cycle came later when the thrust developed. And that can often happen. And it's happened here. So I thought when we did originally a look at the dollar index, this was a bit of a consolidation. We get one more flick down and then it would start to push up. We had this cycle really, starting to accelerate. So we knew the dollar was coming. This is going back to the February low.
Right.
And we knew that some pretty big upswings would develop. And of course, this is the reality since. It had a slightly lower low here, but that was all that came through. It was a very short fifth wave. And I'm very interested in that because
is that like they call that a truncated or a fifth wave failure?
Well, it's not a truncation. It would have to finish above that third wave low there, and it was
okay.
But it's very short. You see, Dale, that's pretty odd. And the same thing happened at the top here, actually. When this peak developed, this fifth wave was actually quite short, and this one was short on the downside. And I got a bit wise to that last month because we're then counting 5 waves up here. And ordinarily, what we would do at this point would be to extend waves 1 to 4 by 61.8. And that would have come up somewhere up here. But I suddenly realized this was pushing the expectation a bit too far because ultimately this is only 5 waves. This is wave A of a zigzag. And if we're projecting wave C beyond such a point like that, it's going to go even way up here. It's not impossible, but you're just lessening the odds, the probability. So because these short fifth waves occurred up here and up here, I suddenly realized that we could have a short one in here. It was the only explanation, the only rational explanation for getting up to this 50% band, because if we measure fib price ratios and put retracements levels in here, look, come down here, you'll see the 50% marker come in.
Oh, yeah.
And I think that 50%.
And we were a little short of that with a double top, kind of made me suspicious of this recent high. That there was no stop, there was no cleansing of the high, the move prior. It was a perfect double top to the pip. So,
yeah, exactly. And it was nice. I mean, it was pretty good to see that. I'm working with log scale charts. You probably might have got the exact, on an arithmetic chart. That could happen sometimes. But for me, that was pretty satisfying to see enough there. I thought, well, the fifth wave in this case is obviously has to be short, and that's where we got to. So when you look at it now, we're in a regression phase down here, and we have to obviously see. I think we're going to see some more dollar declines before this thing goes back up again. I think that's the general concept, and it's the same for the euro inverted. If you take a look at the euro,
right.
We're looking at sort of getting up to the 50% retracement area before.
Yeah, I mean, a lot of people are talking that would be like a head and shoulders top formation. That would be a right shoulder there.
This one, like this. Yeah. So here's the neckline. Yeah. Well, I mean, so if this pops up here, you get the right shoulder, and then down she comes, doesn't she? Yeah.
Okay.
Yeah, I mean, that's not bad. It's not bad. I mean, the thing is that with head and shoulders, of course, if you take that measurement and block it down, you'll get probably somewhere down like that. So it would work out pretty well, I guess. Yeah, that would be perfect.
Right. And that's the end of 2. And then we have the money wave coming sometime next year is when the dollar starts to fail again.
That's right. Yeah. Well, let's have a look at the euro in a bigger scenario. Where are we? Here we go.
Because a lot of people are saying that we're going to challenge the lows from last year, the 103 lows, but that's not what you're seeing here. Just a big pullback, and look at that 202. euro?
Yeah, that's right.
Okay.
Well, we got some.
Yeah.
We got some pretty long-term data here, and we go back to the 1920s when the Reichsmark was basically worthless. So what we're describing.
I had lunch with Jesse Livermore back then. We were talking markets.
I would love to join you.
And
Sorry,
I had to pick up the tab because he was a little early. But, anyway, so wow. I mean, and this has been your view for as long as I've been talking to you, that there's going to be, a rout of the dollar coming up.
Yeah. I mean, this hasn't changed for I can't remember when. I mean, let me just to show you roughly what this looked like. Well, I just found an old chart from yesteryear. This guy, I don't know. This is dated in 1999, 2000, I think, and you can see that ABC X ABC, and this was coming down in a zigzag. And this is ancient, and this is the X wave. We've come up in A since. Actually, it's good also as I keep all my charts, so I like to look through back to see what we've done, and that's another good way of introspection, so that you can see whether you're fooling yourself or not.
Exactly.
But this hasn't changed really for a long time. This is the birth of the euro here. Okay. I never forget that because we had a really nice zigzag in there. You can do this. Measure these numbers down here, but no, this is going up. This is going up a lot. I don't think we're going to go back to 103. Who's saying below 103? Then anybody?
There's some people that are looking for it to take out 103.
Really?
Before there's another low.
Wow.
But, yeah.
Wow.
Anyway, that's what makes a market. I know that. I recall a conversation with you, and it's pretty timely. I don't know if you're prepared for it, but I remember talking to you, it may have been over Skype or we were exchanging notes. And I remember you saying 75 in crude was going to be a sticky area. And we're there now. So I'm wondering what the potential scenarios are from a level that you called a long time ago, the $75 level, and what your thoughts are. Okay.
Yeah, absolutely. Well, I mean, one of the things which was really fantastic on oil going back to the low we saw in February 16 was the fact that, again, this is a really big effect, because we're labeling this decline from the July 08 highs up here down here as a zigzag. So this is, and this is again another very good point. You can't do this work if you're not in log scale, by the way, and you've also got to make sure that your fib price ratios, your extension levels, are set to log. Now I got CKG. I'm using CKG, and I asked them to put this in for me specifically because if I untick this box for a minute, and I'm choosing 100%, okay, and this is a log scale chart, but you watch what happens if I take 100% of this and pull this up to the top here. You can't even see my 100%. Actually, I have to move it up like this. Where is it? Oh, let it go. Hold on. Let's do that again. Yeah, it's in there.
Yeah. So key point being log scale on your fib.
There it is. It slides down so low, I can't even see it. It's somewhere down. It's gone off the scale.
Like minus. We get paid to. It's minus 20. They pay us to fill up our car.
Yeah, exactly. Yeah,
okay.
I'll put it. I'll put in just linear scale. Maybe that's better. You can see it comes down to here. Look, if you take that 100% value and subtract from there, you're getting into minus. Okay, so you can't do that. It's not workable. So what you've got to do, and I've got to remember to put this tick box back in, is just go down like this and subtract from there, and that's where the C wave should finish. This is all about proportionality, which I was talking about earlier. And just because it happens, you shouldn't necessarily believe it. But basically, I'm just.
So 75 doesn't look as sticky. You're looking for 78, 90, 87, 90.
Yeah, well,
before
basically,
we have any kind of decent correction again.
Yeah, what we've got to do is, again, we've got to extend this initial swing up, which is primary wave A. Now, the orthodox top of primary wave A is here. So we extend that by 61.8, and that produces this projection line, which is 78.90. But you'll notice that the B wave, the correction down, was actually what we call a running flat. It drops down wave A here. That's the low in August 16. Then it runs up 3 waves into February 17, then drops 5 down here. So sometimes what you can do is you can include the B wave of the correction to extend.
I remember you liking the crude in the low 40s. So that was a great call.
That's right. So during that time, that correction, that's right. Yeah. And then so you can see the next movement is up here, 87.90. If you include the B wave here. So we've got 2 upside targets, which are, getting very interesting to see. Now, I don't know at the moment which of those 2 will eventually cause a major peak, whether it's going to stop at 78.90 or not. Now, I've got a couple of working hypotheses going on at the moment. One is in which this pulls back and then we get up to 87.90. But I have to admit that if we don't pull back immediately, and this trades up more immediately to 78.90, if you see that happening in the next weeks, so it trades up there immediately, and then suddenly it pulls back really hard, then we've got a reversal signature. And then we know that 78.90 of these 2 upside targets, let's go back to the other one, then the 78.90 will be enough.
Interesting. Okay.
And that means, if we get price rejection there, then we're coming down in wave X to, $55.
Okay. Still looking for 3,200 S&Ps. NASDAQ's made a new high. Russell's threatening again. You've been talking 3,200. I've also seen some corrective calls that you've made. Okay, so interesting.
Yeah, this is the daily chart from 2016. This is what I call the grand resynchronization lows, because back in February 16 we had a sort of a year and a half correction. That was certainly the case in Europe, because most of the European markets were unfolding from a peak in 2015 into that 2016 low. But don't forget that that also occurred when emerging markets and commodities were forming a major low in early 2016, having had a 5-year decline from the 2011 peak. So we've got basically everything re-emerging, converging down there. I called it the grand resynchronization, and that was one of the clearest signals in my career that we should be buying commodities, emerging markets, S&P, whatnot. And
so
since then,
I just wanted, you're one of the first ones that I heard using the synchronized global recovery narrative with what's happening in China, like with the FXI, being very weak, breaking down. Is that narrative still true, that we're still in a synchronized global recovery, or is it starting to lose a piece here and there of participation?
Well, I think it's still basically very much in general growth intact. Yes, I mean the synchronization is aligned. I think you've got the Shanghai Composite, which has been taking a hit. We can look at that in a moment. But just before I leave this S&P, I just want to, this is an incorrect count. I've seen this on blogs and everywhere. It's completely, forget that. This is the S&P schematic, focusing on just this year. Sorry, the data's just loading. But if I give it a bit of a shove, it might encourage it for some reason to come through and be visible. But basically, what we've had this year, this is a remarkable pattern, which we recognized very early on in its scenario. And it's basically a zigzag decline from January's high.
Right.
But there's some really added, this is a very good tutorial for Elliott Wave, because there's a lot of different things going on here. Sorry, this is really not loading very efficiently, but it'll come into focus in a moment. Maybe what I'll show you is what we had back in April, because April was this low down here. And by the time we got into late April, we saw this 3-wave pattern, and we knew it should be 5 waves developing. So we immediately updated this as a diagonal. which it's been working perfectly since. If I show this chart, this is dated 19th of April.
Yeah.
And you can see the general wedge shape of the diagram. It's 5 waves, 1, 2, 3, 4, 5, like this. But the tip-off was the fact that this was a zigzag.
Right.
27.17. And you can see we had a forecast right that time down to 25.90 around that area before it starts to pick up again. Well, have a look now. Here's the low, 25.94.
Right.
And here's the
Very
continuation of it since. It's picture perfect. And if we can get up to 28.28, that's going to be a very, very interesting thing. And then we're going to get this swoosh down. You know,
Okay.
that's 12% drop.
And then the lift off again into the year end. But it looked like your highest numbers, even after this correction, have come down a bit. You didn't have 3,200. You had like 29.95 after this low. Was I reading it? Oh yeah, 29.94. The end.
Well, it could be a little bit higher. Yeah, it could be a little bit higher than that actually. This is a sort of I'm working off
thinking we're good, and even like 4,200 until like the end of 2019, and then we started a generational bear market, and that's the chart I'm talking about.
Yeah,
okay.
This is the one you're referring to. This is now a lot of Elliott guys are talking about 1, 2, 3, 4, and a big terminal fifth here. This is not going to work. Why? Because if we take a look at the emerging markets and the commodity scenario, we're engaged in an inflation pop at the moment from the grand resynchronization lows. That's the second phase beginning here.
Right.
And those markets are very, very far from complete. Now, the commodity sector is undergoing some rotational corrective declines.
That's a good segue, Peter, because I also remember from our last interview when gold was knocking on the door of a breakout at 1360. You said that, you would go with it in case it was, it was the beginning of something. But you said, I'm expecting a false breakout if it happens. And you had some, at the time, some downside targets that we're almost at in gold. Back then, you were talking 1220 as a possibility. And so here we're looking for pretty good break. You're looking for a retest of 2017. That's
right. Well, the reason I was suspicious, the reason I was suspicious that if it did break out above here, we should be very careful for these were the big numbers where I thought that if it did break out, it would hit there and then drop really hard back inside this range. That would have made this an expanding flat if it had traded up a little bit higher. I was pretty confident it would be a false breakout because I could see that this entire upswing from the December 2016 low, which is basically from this point here onwards, there was lots of overlap. This type of configuration is not consistent with a sustained break above the highs, a new bull market, in other words. It was consistent with a more complex correction where you would formulate a top up here and then it would pull all the way back inside the range. And we didn't get the breakout. I was hoping we would because I wanted to see if it would suck in a lot of the institutional fund managers because at the beginning of the year, they were getting at the beginning of the year, the institutional fund managers were all getting very excited about a more immediate sort of persistent inflationary expectations. And I thought, well, if they were also, BlackRock and a few of the big guys were making big noises about inflation picking up, and we saw from the CAT that the long positioning was getting very high. And I thought, well, if this does break out, I don't see that that's going to be conducive to a pronounced and sustained move up. And in fact, in a way, it didn't. It got defended here. And of course, you've seen it drop back since. Right. And I think, this means that we're going to have to wait until the end of the year, early next year, like in all the commodities, like copper and other things like that, and the emerging markets, before they get down like this, before we can go back in. But I if anybody's listening and they've got disorientated with gold because it's done nothing for the last year and a half, don't be too disorientated because when we do get down to these numbers, you're going to have some fantastic buying opportunities. And of course, again, we've got to fight our emotions down here. We'll probably feel as if, you're probably going to
go to 980. You'll sit down there. You'll say, "Well, could trade
Yeah.
under 1,000." You'll be hearing
Exactly.
that.
Yeah.
You're already hearing that.
Oh yeah, yeah. I wouldn't be surprised. I wouldn't be surprised. I remember when we got nearly down to here, people were talking about 800, weren't they, and things like that.
Yeah, there's still some 750 guys out there. Well, you know, let them watch. Peter, another great interview, buddy. You know,
Thanks,
excellent views. And why don't you take a minute or two to show your website and how people could reach you and subscribe and.
Okay, that'd be great. Thanks,
Peter. I really think that Peter's someone that you guys should keep an eye on.
Well, thanks a lot. I really appreciate that, Dale. Well, if anybody's listening and they're interested in Elliott Wave and some of the forecasts that we can make, even if you're not into Elliott Wave per se and you're using other methods, you can always cross-reference what we're saying against your own and measure us up. We're quite used to being put under the microscope in terms of our forecasts, and we try very much to keep a very high degree of forecast to the way that the price action develops. You can always visit us on wavetrack.com. If you do get that far, go to subscriptions, and you can see a very low cost subscription to the Elliott Wave Compass report, which is here. And it's $39 a month. We publish twice a week, some really good reports. And that's one entry level that you can subscribe to us from. And if you're using Twitter, for example, our Twitter account, let me just put that across, is shown here. And our handle is at Elliott Wave _WTI. And we've got a lot of stuff going on. In fact, here we are already.
Yeah.
Our interview today, which is great. And we do put a lot of educational stuff on with, this is extracts from our original material. I'm fortunate enough to have some of Elliott's original works, so we post those occasionally. And a very good feedback came through on what Elliott called a half moon pattern. And we've written up a lot of that stuff. And this is always accessible through our blog as well. So if you get to our blog, you know, you can see full articles which reference from Twitter and so forth. So that's really how we operate. And we'd be love to see and hear from anyone.
Well, thank you so much, Peter. And good luck with England in the World Cup. All right. Maybe they'll put you in the game, so you could draw some waves and patterns for the team to follow.
I wish there was something I could. Yeah, I wish there was some trends there. I could map it out. The score would be fun.
Thank you so much, Peter. Good hunting. Appreciate all the insights and views. So I hope you have a great summer trading season, my trading warrior brother. Thanks for being with us today, bro.
Yeah, you're welcome, Dale, and we'll keep in touch. Thanks again to you.
Okay, everyone, that's our Turnaround Tuesday with Peter Goodburn. You know where to find him. There's his website, and it's Elliott Wave _WTI on Twitter. Hope you guys enjoy the rest of the day. Let's see what's happening here before I say goodbye. Euro, still, I'd like to see you close over 1720. Okay, everyone. Good hunting. See everyone tomorrow. Remember, don't just count your pips, count your blessings. Adios. Thanks again, Pete.